In this video, we are going to talk about retirement planning. Secure your future today. So before starting this video, please like this video and subscribe to our channel for future updates. Retirement planning is a multi-step process that evolves over time. To have a comfortable, secure, and fun retirement, you need to build the financial cushion that will fund it all. The fun part is why it makes sense to pay attention to the serious and perhaps boring part, planning how you'll get there. Retirement planning starts with thinking about your retirement goals and how long you have to meet them. Then you need to look at the types of retirement accounts that can help you raise the money to fund your future. As you save that money, you have to invest it to enable it to grow. While there is no fixed rule about how much money to save, many retirement experts offer rules of thumb, such as saving about $1 million or 12 years of one's pre-retirement annual income. Others recommend the 4% rule, which suggests that retirees should spend no more than 4% of their retirement savings each year in order to ensure a comfortable retirement. Number 1. Understand your time horizon. Your current age and expected retirement age create the initial groundwork for an effective retirement strategy. The longer the time from today to retirement, the higher the level of risk that your portfolio can withstand. If you're young and have 30+ years until retirement, you can have the majority of your assets in riskier investments, such as stocks. There will be volatility, but stocks have historically outperformed other securities, such as bonds, over long time periods. The main word here is long, meaning at least more than 10 years. Additionally, you need returns that outpace inflation so you can maintain your purchasing power during retirement. Inflation is like an acorn. It starts out small, but given enough time, can turn into a mighty oak tree, says Chris Hammond, a Savannah 10 financial advisor and founder of retirementplanningmadeeasy.com. Number 2. Determine retirement spending needs. Having realistic expectations about post-retirement spending habits will help you define the required size of a retirement portfolio. Most people believe that after retirement, their annual spending will amount to only 70% to 80% of what they spent previously. Such an assumption is often proven unrealistic, especially if the mortgage has not been paid off, or if unforeseen medical expenses occur. Retired adults also sometimes spend their first years splurging on travel or other bucket list goals. For retired adults to have enough savings for retirement, I believe that the ratio should be closer to 100%, says David G. Niggle, CFP, JFC, AIF, founder, president, and CEO of Key Wealth Partners LLC in Littles, PA. The cost of living is increasing every year, especially healthcare expenses. People are living longer and want to thrive in retirement. Retired adults need more income for a longer time, so they will need to save and invest accordingly. As, by definition, retired adults are no longer at work for 8 or more hours a day. They have more time to travel, go sightseeing, shop, and engage in other expensive activities. Accurate retirement spending goals help in the planning process, as more spending in the future requires additional savings today. Number 3. Calculate after-tax rate of investment returns. Once the expected time horizons and spending requirements are determined, the after-tax real rate of return must be calculated to assess the feasibility of the portfolio producing the needed income. A required rate of return in excess of 10% before taxes is normally an unrealistic expectation, even for long-term investing. As you age, this return threshold goes down, as low-risk retirement portfolios are largely composed of low-yielding fixed-income securities. Number 4. Assess risk tolerance versus investment goals. Whether it's you or a professional money manager who is in charge of the investment decisions, a proper portfolio allocation that balances the concerns of risk aversion and returns objectives is arguably the most important step in retirement planning. How much risk are you willing to take to meet your objectives? Should some income be set aside in risk-free treasury bonds for required expenditures? You need to make sure that you are comfortable with the risks being taken in your portfolio and know what is necessary and what is a luxury. Don't be a micromanager who reacts to daily market noise, advises Craig L. Israelson, Page B, designer of 712 Portfolio in Springville, Utah. Number 5. Stay on top of estate planning. Estate planning is another key step in a well-rounded retirement plan, and each aspect requires the expertise of different professionals, such as lawyers and accountants, in that specific field. Life insurance is also an important part of an estate plan and the retirement planning process. Having both a proper estate plan and life insurance coverage ensures that your assets are distributed in a manner of your choosing, and that your loved ones will not experience financial hardship following your death. A carefully outlined plan also aids in avoiding an expensive and often lengthy probate process. Tax planning is another crucial part of the estate planning process. If an individual wishes to leave assets to family members or a charity, the tax implications of either gifting or passing them through the estate process must be compared. So this is our today's video. If you like our video, don't forget to subscribe to our channel or hit the bell icon. We will meet again with another interesting topic. Till then, stay safe and stay happy.